I think right now there's a lot more people in their 20s that want to invest than ever before, but they don't know where to start. And it's hard watching people online with six-figure portfolios tell you what to do when you're still trying to build your first few thousand or 100. I'm showing the process from the beginning, what I'm investing in, why I'm investing in it, and how I'm trying to build a portfolio before there's anything to flex. Because that's the part most people actually live in, not the part where you already have everything figured out. Right now, I'm not working with a massive portfolio, but you have to start somewhere. The first investment I ever made was $50 back in 2021, but I never understood investing or building wealth. I just bought a stock, held it for a couple months, and when it didn't make me rich, I sold it. Same with crypto. This isn't a get-rich-quick scheme, because I've tried all of them. Seriously, anything from day trading, starting a business, drop shipping, and I just got tired of getting no results. So I sat down and watched what others did. I watched people like PJ Finance, Wylearn, Polly Walnuts, except these guys all had their 100K portfolios. So I figured, why not show people a normal starting point and let's compound over time together. So before I even talk about what I invest in, I think it's important to be transparent about where I'm starting. I have money in a high yield savings account, and I'll show that to you right here on the screen. I have money in a brokerage account, and I made my first contribution to my Roth IRA this last paycheck. But I also have debt, my car. I've been paying this puppy off the last 3 years, $14K, and now it's down to $2,140. And I can't wait to pay it off. I don't plan to ever let myself have another car payment again. All that money could have been invested, but I was young, dumb, and wanted a decent car. And that's real life. That's where a lot of people are. But again, we all start somewhere. You might have some savings, but not enough to feel fully secure. You might have started investing, but it still feels small. You might have debt, but you also don't want to wait forever to start building wealth. And that's the tension, because in your 20s, you're trying to do everything at once. You're trying to save, you're trying to invest, you're trying to pay off debt, you're trying to build income, you're trying to enjoy life a little bit. And on top of that, everything feels expensive. So when I talk about the stocks and ETFs I invest in, I'm not coming from the angle of, oh, I already made it, so copy me. I'm coming from the angle of, this is the system I'm using to get there. The main thing I care about right now is building a foundation, not chasing every stock, not trying to get rich overnight, not gambling everything on one company, because I've done that. Sure, you might win some, but you'll always end up losing. It's like a casino. The longer you play while you're up, you'll eventually lose it all. So now the goal is to build something that can last. So my portfolio is built around a simple idea: core first, risk second. That means most of my money goes into broad investments that give me exposure to the overall market. Then if I want to take more risk, I do that with a smaller portion, because I think one of the biggest mistakes people make when they start investing is they go straight to the exciting stuff. They want the next big company, the one that everybody's talking about, but they don't even have a foundation yet. And if you don't know already, retail is always late. So the first major investment I focus on is VU. This is 60% of my portfolio. VU tracks the S&P 500, which means it gives exposure to around 500 of the biggest companies in the United States. Now there's so many ETFs like it. You can go to SPY, SPYM. There's so many that do the same exact thing, but the reason I like VU is because it has the lowest expense ratio. It has an expense ratio of 0.03%. For every $1,000, you're paying 3 cents to hold it every year. With all these other ones, you're getting anywhere from 0.14% or 0.09%. And over time, once you get a big portfolio, 100K, 200K, this can make a big difference. So VU is my biggest holding, and that's why I like it. It has the lowest expense ratio. I pay the least amount to hold it. And each ETF you have to pay. So when I invest in VU, I'm not betting on one company, I'm betting on the overall strength of the US market. Companies like Apple, Microsoft, Nvidia, Amazon, Google, Meta, and a lot of other major businesses are inside of it. That's why I like it as a core holding. It's simple, it's diversified, and it gives me exposure to companies that are already deeply tied in the economy. Now, that doesn't mean VU can't go down. It absolutely can go down. The market can drop, recessions can happen, corrections happen, but I'm not buying VU because I think it only goes up every month. I'm buying it because over long periods of time, owning productive companies has historically been one of the best ways to build wealth. And that's the key phrase, long periods of time. I'm not looking at VU like a quick trade. I'm looking at it as the base of my portfolio, the thing I can add to over and over again, every paycheck, every month, even when it feels boring. The second ETF I invest in is QQQM, and this tracks the NASDAQ 100, so it gives me exposure to technology and growth companies. This is where I get more aggressive because I'm young, I have time, and I do want exposure to innovation. And you might wonder why QQQM and not QQQ. QQQM has a lower expense ratio than most of these other QQQs. And with QQQM, I get exposure to AI, cloud computing, software, semiconductors, automation, and big tech. These are all things that are going to be shaping the future. But I also understand that growth comes with more volatility. QQQM can move harder than something like VU. That means when things are good, it can perform really well, but when markets pull back, it can also fall harder. This is why it's only 20% of my portfolio. VU is the foundation, QQQM is the accelerator, And that's how I think about it, because I don't want to miss out on growth, but I also don't want my whole plan depending on the most expensive parts of the market continuing to go straight up. And that's where balance matters. A lot of people either go too safe or too risky. I'm trying to stay somewhere in the middle. Another ETF I use is VXUS. This gives exposure to international stocks outside of the United States. And I'll be honest, this one is not as exciting. Nobody really gets hyped about international diversification. It's not the thing that people talk about when they're trying to go viral, but I think it has a place. Even though the US market has been incredibly strong, I don't want 100% of my future tied to one country. I think we can all agree the US feels like it's been declining. That doesn't mean the US can't continue dominating. It might. But nobody knows the future, and having some international exposure gives the portfolio another layer of diversification. That doesn't mean I'm betting against America, it just means I'm not pretending I know exactly which market will lead forever. So for me, VXUS is not the biggest position. It's not the main engine, but it plays a role. It gives balance, and I think that's what a lot of people miss when they build portfolios. Every position should have a job. Another thing I'm trying to be intentional about is where I invest, because it's not just about what you buy, it's also about what account you use. A brokerage account gives you flexibility. You can invest, sell, move money, and use it before retirement if you need to. That matters for someone like me because I'm still building. I still have goals before age 60. I want to move out, I want to keep building my savings, I want to keep options open, but a Roth IRA is different. That's long-term retirement money. The benefit is that if you follow the rules, the growth can be tax-free later. So even though my Roth IRA is small right now, I still want to build a habit. I still want to build the habit to contributing to it, because the earlier you start, the more time the money has to grow, and you can only invest $7,000 each year. And I think that's the part people underestimate. It doesn't feel like much when you're first starting with a few $100s. I mean, when I put in my first $350 in there, I was like, well, why wouldn't I just invest this into something else that can grow faster? But it's all about starting. You just have to build the habit, build the system. That's what really matters, because a few hundred becomes a few thousand becomes 10,000, and over time, if you stay consistent, that becomes something real. That's why I'm not embarrassed about starting small. Starting small is still starting. Now, when it comes to individual stocks, this is where I try to be more careful, but I still like to have fun, and this gives me a level of excitement into my portfolio, because they can grow faster, but they can also wreck your progress if you don't know what you're doing. So I don't want my entire financial future depending on one or two companies. If I buy individual stocks, I want them to be a smaller part of the portfolio. That way I can still participate in upside without risking the whole system. And the individual stocks I invest in, I have in a previous video. If you want to go see that, you can see why I invest in those. But I have APLD, IonQ, Arista Networks, and Grab. And I only buy them when they go under my entry price. For me, individual stocks are opportunity plays. They're not the foundation, and I think that distinction is important, because a lot of young investors do the opposite. They put most of their money into the riskiest ideas and then treat ETFs like the boring side piece. I want to flip that. The foundation should be boring. The risk should be controlled. That way, if one individual stock doesn't work out, it doesn't destroy the whole plan. And if one does work out, great, it adds upside. But the portfolio doesn't depend on it. That's the difference between investing and just straight up gambling. And this is really the part I want this channel to focus on, because most finance content skips over the small decisions. They tell you to invest, they tell you to save, they tell you to avoid debt, but real life is not that clean. Real life is asking, should I pay off my car faster or keep investing? Should I keep more cash in my high yield savings account or put more into VU? Should I fund my Roth IRA first or my brokerage account? These are decisions that actually matter when you're building from the beginning, and they're not always obvious. Sometimes there are two good options. Sometimes the best decision is the one you can actually stick to. That's why I want to document the process, not only for someone out there who this might benefit, but also for myself, to hold myself accountable and stick to it while being able to see my progress over time. And whenever you, on the other side of the screen, start to watch these videos, you'll be able to see what I chose, why I chose it, and where it led. You'll see what worked, you'll see what didn't, you'll see where I changed my mind, and honestly, you'll probably see where I messed up too, but that's part of the point, because this is real. This isn't a perfect highlight reel, it's the actual build. And I think this matters especially for people in their 20s right now, because a lot of Gen Z is in a weird financial position. We're told to invest early, but everything is expensive. We're told to save money, but rent, food, insurance, cars, and basic life costs are all high. We're told to build skills and make more money, but at the same time, it feels like the goalposts keep moving. So it's easy to feel behind. It's easy to look at someone with a six-figure portfolio and think, I'm never going to catch up. But the truth is, most people don't start with 100,000. They start with a few hundred, a few thousand, some savings, some debt, a normal job, and a decision to finally take it serious. And that's where I'm at. And that's who this channel is for. But remember, the system is what keeps everything moving in the right direction. Invest consistently, save intentionally, control risk, avoid lifestyle inflation, make better decisions each paycheck, and document the process as it happens. I'm not here to pretend I already made it. I'm here to show what it looks like to build from the beginning. And if you're in the same stage trying to figure out how to save, invest, pay off debt, and actually get ahead, then leave a comment, because this is the journey we are in together. Not the flashy version, the real one. So hit the subscribe button, leave a like, and let's continue this journey one day at a time. I appreciate you guys for watching, and I'll catch you in the next one. Peace.